$68,000. That was the minimum one retired couple had to take from their retirement accounts in a year when they did not need the money. The full pre-tax amount still counted as ordinary income. That withdrawal made more of their Social Security taxable, and if their total income crossed the line, it could raise their Medicare premiums 2 years later. And here is the strange part. Their retirement account had not failed. It had grown. If most of your retirement savings are in a traditional 401k or IRA, you could eventually lose some control over how much taxable income those accounts create. So how can an account that grows exactly as planned leave you with fewer choices? Daniel and Linda had done what retirement savers are told to do. For 30 years, they took the employer match, made pre-tax contributions, and let the money compound. It worked. They retired with about $1.5 million, spent carefully, and watched the balance grow to nearly $1.8 million. Every year, the account looked safer. Then the first required withdrawal appeared. Linda looked at the required number and said what most people would say, "But we don't need that much." Need was no longer the deciding factor. They could still withdraw more if they wanted. What they could no longer choose was to withdraw less than the required minimum. So the money came out. It was not paying for a new roof, covering medical care, or funding a vacation. It was not meeting any new need. Some of it might simply sit in cash or move into a separate taxable account. But once the full pre-tax distribution came out, it generally counted as ordinary income. So where did that number come from? It came from a rule called a required minimum distribution, or RMD. Under current law, RMDs generally begin at age 73 or 75, depending on birth year. The amount is calculated using the previous year-end balance and an age-based factor. A larger balance means a larger required dollar withdrawal, and as the account owner gets older, the required percentage generally rises. The rule does not ask whether the household needs the money. Before RMDs, Daniel and Linda largely decided how much taxable income to create from those accounts in a given year. After RMDs began, part of that decision was no longer optional. And the tax effect did not stop with the withdrawal. It raised the income on their tax return, and that income pulled more of their Social Security benefit into the taxable column. Up to 85% of Social Security benefits can be included in taxable income once combined income crosses certain levels. That does not mean 85% of the benefit disappears, and it does not mean the benefit is taxed at an 85% rate. It means a larger share of the benefit becomes subject to the household's normal tax rate. Daniel and Linda had not changed their Social Security check. They had not asked for more money, and they had not done anything different from the year before. But because the required withdrawal pushed their other income higher, a larger share of their Social Security benefit became taxable. One required withdrawal, 2 results on the same tax return, and neither result came from spending more. Depending on their other income, Medicare could be next. Because the withdrawal increased their modified adjusted gross income, it could also affect Medicare premiums through IRMAA, but not immediately. Medicare generally looks back 2 years. A high-income year may not affect Medicare premiums until much later. By then, it can be easy to miss the connection between the higher bill and a withdrawal that happened 2 years earlier. That is why a Medicare premium change can feel as though it came from nowhere. The withdrawal happened first. A Medicare consequence could follow later if their income crossed an IRMAA threshold. Their lifestyle had not changed. Their tax picture had. So they took only the required minimum and left everything else invested. It sounded conservative. It was the same restraint that had built the account in the first place. But if the remaining balance earned more than the required withdrawal, the account could stay high. So could the next RMD, taking the minimum, reduce that year's withdrawal? It did not restore the choices they had before RMDs began. This does not happen in every account. It depends on returns, spending, other income, and the size of the balance. But it raised the harder question. Was their real mistake saving too much? No. The size of the account was never the real issue. The issue was where the money was held. Their investments were diversified across funds, asset classes, and different parts of the market. But nearly every dollar they had saved sat inside accounts governed by the same future rule: withdraw it, and it generally counts as ordinary income. Later in life, a minimum amount must begin coming out. They did not save too much. They saved almost everything under one set of tax rules. They had many investments, but only one main way for those investments to become retirement income. Here is the part that could have given Daniel and Linda more options. There was a planning window, and they let it pass without realizing why it mattered. Look back at their 60s. Paychecks had stopped, they had delayed Social Security, and required withdrawals were still years away. For them, those years could have been among the lowest income years of retirement. Yet they made no changes because the account was growing, and everything looked fine. That kind of window can give a household room to make deliberate choices before required withdrawals begin. Daniel and Linda did not need one perfect account. They needed another way to create retirement income. If some of their money had been in a Roth account, qualified withdrawals could have covered a future expense without adding taxable income in the same way. If some of their money had been in a taxable brokerage account, they could have accessed it under a different set of tax rules. Instead of treating the full withdrawal as ordinary income, neither account would have erased taxes. But together, they could have given Daniel and Linda something their traditional accounts could not give them in that moment: a choice. In their lower income 60s, Daniel and Linda could have considered whether to move some money from the traditional account into a Roth a little at a time. That might have allowed them to pay some tax earlier, possibly at a lower rate, while also reducing the traditional balance that future required withdrawals would be based on. Not all of it, just enough to build another source of retirement money that would not appear on every future tax return in the same way. It would not have been free. A Roth conversion creates taxable income in the year it happens. Move too much, and it can raise the current tax bill, push income into a higher bracket, or affect Medicare premiums later. Done poorly, it can backfire, but evaluated carefully during lower income years, it can provide another key. Daniel and Linda had time to create other keys. They simply did not realize they would need them later. If any of this sounds familiar, 3 questions are worth sitting with. How much of your retirement money is still pre-tax? What could that balance become before your RMDs begin? And when you do not want more taxable income, do you have another account you can use? Those answers change with filing status, pensions, state taxes, and your actual balances. Before a large withdrawal or conversion, run your own numbers with a qualified tax professional or fiduciary advisor. Daniel and Linda did not fail. Their saving worked. What they lost was some control over when that money became taxable. A large balance matters, but spreading that balance across more than one tax treatment can give you something a single account cannot: choices. Some retirement decisions look simple while you are still working. Their real shape appears only after taxes, Social Security, and Medicare begin interacting. Subscribe, and we will work through the next one together.